Hello and welcome to the session. This is Professor Farhat. In this session, we're going to be doing accounting for the general fund. Before we start, I just want to make sure you understand that we have to know a few things before we start the session. Do you know what modified accrual accounting is? If not, please go to my modified accrual accounting session and view modified accrual. Make sure you understand this. Also, you want to know how does governmental budgeting work, appropriation, encumbrances, and estimated revenues, which I have a recording for that. And we're going to deal with transaction with interfund governmental activities. So those are helpful if you know them before you start the session. Otherwise, you can go through the example, but to really understand what we're going to go through is you have to understand those three topics. So let's start by doing a quick review about fund accounting. What is fund accounting? Well, again, what is the purpose of fund accounting? The purpose of fund accounting is accountability, to keep the government accountable for certain things. So the purpose of fund accounting is to segregate those financial resources that have constraint or limitation on their use so that the government may demonstrate compliance with those limitations. So if we are raising money from a certain purpose, like for example, if we are imposing taxes on gasoline to maintain the road, we want to make sure we have a certain fund that's going to account for that money. So this is what we do, is we create certain fund to do what? To keep the government accountable so they are complying with what they're supposed to be doing. So that's the purpose. So in this session, we're going to be dealing with the general fund. What does the general fund report on? It reports on those resources that not subject to any restriction. So basically the general fund, the money there, the assets, they have unrestricted use. That's basically what the general fund is. And basically the definition of a general fund, the general fund is used to account and report all financial resources not accounted for and reported in any other fund. So anything that's not reported in any other fund, it's going to be in the general fund. And how many general fund do we have? Each government will have one general fund. Okay, so what are the other funds? Just to kind of make sure we understand what are the other funds. What are the other funds? We have four other funds. One is the permanent fund, and we could have many sub-permanent funds, sub-capital project funds, so on and so forth, but one general fund. Well, what does the permanent fund account for? It accounts for resources provided under a trust agreement that are restricted so that only earnings may be expended for the purpose that benefit the public. For example, someone contributed $1 million for the library, the museum, the zoo, and they want to use the earnings, the interest and the dividend, to maintain the library, the museum, and the zoo. So the government is responsible for complying with that request. Capital Project Fund is another fund, and again, we cover all of those in my course. Account for and report financial resources. Financial resources means money that are restricted, committed, or assigned to expenditure of capital outlays. So notice we don't maintain the capital asset itself, the building, the road, the bridge. What we're looking for, we are accounting for the financial resources, for the money. The debt service fund account for and report financial resources, it means money, that are restricted, committed, or assigned to expenditure for principal and interest. So remember, we don't account for the debt itself, for the bond itself, we account for the money, So in the fund, we don't account for the debt, we don't account for the capital asset. So simply put, we have in the funds, we have no long-term assets and no long-term liability. This is what we learn about when we learn about the fund. The special purpose funds, and notice they're all funds, plural, because you could have many funds, account for and report the proceeds of a specific revenue source that are restricted, committed, or committed to expenditure for a specified purpose other than the debt service and the capital project. So if it's not debt service, it's not capital project. For example, we are imposing a tax on gasoline again to maintain the roads. So this is what the capital project fund, the special revenue fund is for. Remember, we have accrual and modified accrual to form two of the accounting bases that you could use. Again, accrual we use for private companies, recognize revenue when earned, match expenses against revenues. We don't use this for governmental accounting. For governmental accounting, we use modified accrual, and I spent half an hour explaining modified accrual. Simply put, in a nutshell, what is modified accrual? Recognize revenue when measurable and available. What is available? Available is to pay this year's bill. For example, property received within 60 days of year end. Again, if you don't know what modified accrual, by all means, this is the short explanation, but I have a 30-minute explanation. And under modified accrual, recognize expenditure when the liability is incurred. No attempt to match the revenue, match to period to occurrence only. So this is what the expenditure is. There's one exception: recognize interest and principal payment as the expenditure when due. Once again, I have a whole session about expenditure, a whole session about modified accrual. By all means, you can go back and review them in detail. But in this session, I'm just going to go through a comprehensive example, which is going to be very beneficial if you really want to understand how the general fund works. So this is the trial balance for a company called the Village, not a company, a village, basically, a governmental unit. And this is the trial balance as of end of 2016. So this is 12/31/2016. So this is the Village, and this is their trial balance. They have cash 100,000, taxes receivable of 400,000, estimated uncollectible taxes 40,000, interest and penalties receivable on taxes 25. They estimate not to collect 10,000. Those are basically their assets. Then they have accounts payable. Then they have deferred inflow of property tax. And again, what is this account? This account is important because it's not used in private accounting. Therefore, many students say, what is deferred inflow of property taxes? Remember, they have taxes receivable of 400,000. They expect to receive it, of which 200 will be reported. So this is how it works. So this is year one, and this is year two. In year one, we send 400,000 of bills. So the receivable is 400,000. Of this amount, as long as it's going to be collected within 60 days, it's revenue. It was revenue. It was revenue accounted for. But there are 20,000 that's going to be collected longer than 60 days. So it's going to be $20,000. It's going to be collected. It won't be collected until 60 days after year end, after 60 days. Therefore, what we do, it's called deferred inflow. So it's not revenue yet. So it's going to be revenue in 2017. So we cannot count it as revenue in 2016. Okay, this is what we mean by deferred revenue. Due to federal government, we owe the federal government 30,000, and there's a fund balance of 290,000. And for the purpose of this, we need to illustrate that the fund balance of this amount, 45,000 of this amount is assigned for unfilled purchase orders, so unfilled encumbrances. So of this 290,000, 45,000 is unfilled orders from 2016, which we hopefully we're going to fill in 2017, which we fill, and 245,000 of this fund, which is the remainder. If 290 is total, 45 for unfilled order, what's left is 245, and this is unassigned fund balance, which is we can do whatever we want with it. Now, here's what's going to happen. We're going to go through more than 20, I believe around 25 to 28 transactions. So I'm not going to go and update the T account for each transaction, but what I suggest you do is to open T accounts. What do I mean by this? Here's what we're going to end up. We're going to end up with these accounts. So those are all the accounts we're going to be using in this example. And obviously these accounts are already filled. So again, you don't want to do this because they're already filled. You want to go through the example. But here's what you need to do. You want to start a cash account, and the beginning balance is 100,000. Taxes receivable, the beginning balance is 400,000. Estimated uncollectible, the beginning balance is 40,000. Notice those are the beginning balances. So if you want to go through this, if you want to go through the example altogether, you want to create those T accounts that I'm highlighting now. Some has beginning balance, some does not. Obviously, we have no revenues yet, no expenditure. In other words, there's no beginning balances. Okay, so you want to create those. Pause the recording, and what you need to do, create a T account. If there's any beginning balance, input the beginning balance there, and those are the budgetary accounts, which also you want to keep track of as well. Okay, so please pause the recording, start those T accounts, and this is the end product we're going to end up with. But don't copy it, obviously. Follow the instruction. So the first thing we're going to do is record the budget. Again, GASB does not require governmental unit to prepare a budget, but most government, they do prepare a budget. So at the beginning of 2017, the Village record the general fund budget. So we're going to start with the budget. Here's what's going to happen. Assume estimated revenue is 620,000, appropriation of 5.2 million, and planned transfer to the debt service 204, and a planned transfer to establish an internal service fund of 596. We're going to wait on the internal service fund. We're going to process this later because it's an inter-fund transfer. Just ignore this for now. Ignore this 596. So we're going to start the budget. So what do we need to do? We estimate revenue, therefore it's debit. Remember, this is estimated revenue, not revenue. So this is the budget. So remember, these are budgetary account. This is estimated revenue, not revenue. If you don't know how this works, go to the budget. How do we create a budget? Fund accounting and budgeting, and you're gonna understand why this is a debit. Basically, it's estimated revenue, not revenue. So estimated revenue, this is how much we estimate. We estimate to spend 5.2 million appropriation control, basically the expenditure that we think we're gonna spend. Estimated other finance and uses control, we're gonna transfer 800,000 in total, 204 plus 596, 800,000 in total. Therefore, the budgetary fund balance is 200,000. And basically, if you really think about it, again, what I'm gonna do, I'm gonna look at the this 596,000. I told you to ignore it. We're going to look at it later on when we do interfund transfer. That's why it's combined with this 800,000. So this 800,000 is the 204 plus the 596. This is 800,000. Okay. So what does that mean? It means we estimate to generate revenues of 6.2 million, expenditure to be more specific, not to be more specific, to use the appropriate term, 5.2 million. Estimated other financing, we're going to transfer 800,000. And basically, if everything works as well, we're going to have an increase in the fund balance of 200,000. That's the goal. Okay. So I'm going to ask you this: what happened to this entry at the end of the year? What's going to, at the end of the period? Yeah, what's going to be a year? It's going to be closed. So we're going to have to close this exactly this entry, unless what? Unless we change some estimates. And in this example, we're going to do some changes to the budget. You will see later on. Now remember, this entry does not appear in the general purpose financial statement because this is budget. This is the budget. It does not appear anywhere in the financial statement. And we open it now, we use it at the end of the year. Before we prepare the financial statement, we close it. So it doesn't appear in the general purpose financial statement. This is important. So let's take a look at another entry. And entry number 2, and the reason I have, notice here, I have 1, I have 2. So if you are following with me on these T accounts, notice they have entry 1, entry 2. So let me show you what I mean by this. So this is where I'm gonna number them. So this is entry number 1, this is entry number 1. So this way, when you are following, you know how to follow. So when you see 2 here, it means this is entry number 2. And entry number 2 is to reestablish the encumbrance. Remember, in the trial balance, if you look at the trial balance, I told you of the 290,000, 45 was reserved for encumbrance. And what we do in this government, they do honor their encumbrances. Therefore, once the year starts, they reestablish the encumbrance. So here's what's going to happen. We're going to reestablish the encumbrance. We're going to debit encumbrance, and this is from the prior year. So we had 45,000 of unfilled order from the prior year. Now we're going to reestablish the encumbrance and credit budgetary fund balance reserved for encumbrances. Just this way, we know we have 45,000 waiting to be spent. So this is transaction 2. Okay. Now, again, I'm going to show you the trial balance a few times at the beginning of the year. Then I'm not going to show it to you anymore. This is the original trial balance. So basically what we did is we reestablished this 290,000. Remember, we said we have 20,000 of deferred inflow property, of property taxes. What does that mean? It means that's the amount we're going to be receiving 60 days in 2017. So remember, this is 60 days, this is year 1, and this is year 2. Now, this 20,000, we're going to be receiving 60 days after the beginning of year 2. So January and February, we will not be receiving this money. We're going to be receiving this money starting March till the end of the year. Now, since we're going to be receiving it, it's going to turn into revenue. So the deferred inflow, it's going to turn into revenue. And remember, here's what's going to happen at the end of this year. At the end of this year, when we get to 12/31/2017, we're going to do the same thing. We're going to estimate how much we're going to be receiving 60 days in 2018, and anything that we're not going to be collecting, it's going to be deferred. What you're going to see, I believe the last entry in this exercise is to reestablish this, not reestablish, is to estimate the deferred inflow. But now, since we're going to be collecting this money at the end of the year, the village of Riverside deferred 20,000 in the property taxes, and that amount is reflected in the beginning trial balance, which I showed you. Now what's going to happen, we're going to receive this money. We expect to receive it and use it, therefore it turned into revenue. Therefore, we remove the deferred inflow of property taxes. Now the deferred inflow should be 0, okay? Because we had 20,000 credit, we debited it. Then we credit revenue control, and this is revenue for property taxes, just kind of property taxes, okay? The amount will be available. Why did we do this? Because the amount, this 20,000, will be available in 2017. So therefore, this balance now is zero. This balance now is zero, okay? So notice before we proceed, we have 100,000 in cash, and we have liabilities of 135, accounts payable, and due to the federal government 165. So notice if we have $100,000 in cash, we may want to need some money before we at the beginning of the year, because we have a lot of liabilities. So here's what's going to happen. We're going to issue tax anticipation note, basically borrow money. That's basically what it is. This is transaction 4. So here's what's going to happen. Payroll and other liabilities are incurred and must be paid before substantial amount of cash will be collected. So the government have few payments. So what are they going to do? They're going to go to the bank. The tax in power of the village secure a short-term loan from local banks. So basically we went to the bank. We said, look, we have money coming in from taxing the population, the citizens. We need money for now to operate. We are short on money. Assuming we borrowed $200,000, what entry do we make? If we borrowed cash, we're going to debit cash. Cash goes up by 40,000, and we're going to credit tax anticipation note of 200,000, not 20,000. Okay. Now you might be saying, hold on a second. We don't record liabilities. We don't record long-term liabilities. This is short-term. So this loan is a short-term loan. Okay. This is a short-term loan, not long-term loan. Okay. Now remember, we have the accounts payable and due to the federal government. Let's assume we paid it. We paid it now because we have cash. We brought cash in, so we credit cash 165. Debit accounts payable, credit the federal government. So basically, what's going to happen? What we did is, by borrowing money, we increased cash. And what we did is we paid off this liability and we paid off this liability after we increased the cash. Again, I'm not showing you the subledger because it will take time to show you to update each subledger, but I'm sure that if you are in governmental course, you know how this works. Now we're gonna start to issue encumbrances. Again, what is encumbrances? Is when we issue purchase order, we want to make sure that the money is reserved for that purpose. So we issued purchase orders for material and supplies in the amount of 826,000. What does that mean? It means we are planning to buy 826 worth of material supply. So what we do is we encumber this account, we put it on the side. So what we do is we debit encumbrance control 826, and we credit budgetary fund balance reserve for encumbrances 826. We didn't do anything yet, just we issued the purchase order. We did not receive anything yet, but we want to reserve this amount so no one uses it. We know it's being used. Okay. Another thing that the government do, and this is the main thing that they do, they levy property taxes on citizens. This is how they raise their money. So here's what's going to happen. Assume the gross amount of the current property tax levy is $3,265,306. And after considering local economic conditions and the village tax collection policy, we estimate that 2% of these taxes will be uncollectible. So what's going to happen is now we're going to start to recognize our revenue. Can we recognize our revenue before we receive it? Yes, we can. Yes, we can. Remember what we learned about when we talked about revenue recognition. Okay, so we debit taxes receivable, $3,265,306. Credit estimated uncollectible taxes. This is amount we don't think we're going to be able to collect, $65,306. And revenue, our net revenue is $3.2 million. Again, what type of revenue is this? This is property taxes revenue. So why am I saying, assign the revenue? Because at the end of the session, I'm going to show you the income statement, so you will see the revenue is broken down into various types. This is property tax, but it's a source of revenue. Okay. Now we're going to start to collect, and we're going to be collecting some delinquent taxes. Okay, so this is transaction 8. In the current year, the village of Riverside collected delinquent taxes in the amount of $320,000, on which interest and penalties of $20,000 has been incurred at the end of 2016. So we collected $320,000, and in addition to the collection of this delinquent taxes, we imposed taxes and penalties. So in total, we collected 330 plus 20,000. Plus 20,000. Further, 3,000 additional interest was accrued for the period from the first day of 2016 to the dates on which delinquent taxes were collected. Again, so we collected 300,000 of taxes and 20,000 of penalties in 2016. Then again, because we collected this money in 2017, there was an additional fees that were incurred. So let's look at the cash entry first, okay? So ignore this one for now. So we collected cash 353,000. Let me break it down to you. Where did this 353 came from? 330 for just basically receivable, right? Because those are taxes receivable that the people owed us. Of this amount, of the 330, 20,000 were interest and penalties for 2016. Because at the end of 2016, if you look at the trial balance, you had interest and penalties. And this 20,000 belonged to this 330,000. And $3,000, again, of interest and penalties that were incurred in 2017. That were incurred. This is for 2017. So this is how much money we collected, 353, okay? Debit cash. But we have not recorded this $3,000. So what we do is we debit interest and penalties receivable, $3,000 first for year 2017 to put the receivable on the books because we charged them $3,000 and we credit revenue control $3,000. So this is the first entry we make. Let me just remove this. So the first entry you make is to impose the $3,000 of penalties that were incurred in 2017. We did this right here in this entry. Then you debit the cash, 353. You credit receivable, 330, and you credit interest and penalty receivable, 20,000. This is for 2016. Okay. So the revenue for the interest and penalties was recorded in 2017, and the 2016 interest and taxes receivable was collected. Okay, so this is this entry, delinquent collection of delinquent taxes. And what type of a revenue is this? This is interest and penalties. So this is the revenue here is interest and penalties. Interest and penalties. Collection of current taxes. This is good. Now we're collecting the taxes that we issued for this year. And how much did we collected? We collected 2.7 million. That's easy. Debit cash, credit taxes receivable. So what are we collecting here? Let me just show you. We are collecting the taxes that we estimated. Remember, we estimated 3,265,306, and we collected of this 2.7 million. This is what we did in this entry, which is good. We're collecting our taxes. Okay. Now, is taxes the only revenue for the government? No, they could have other revenues such as sales tax. So at the time of sale in this jurisdiction, sales taxes are paid to retailer whom they submit them to the state government. So first the taxes goes to the state government, that the state government send the money to the village. Okay, so during the current year, 1,350,000 of sales tax resulting in 2017. So this is during this year. Sales tax are received by the village from the state government. So we receive this amount. So obviously we're going to have to debit cash, 1,350,000, credit revenue, and this is from sales tax revenue, 1,350,000. Okay. An additional 60,000 resulting from sales during the final week of 2017 are expected to be received in 2018. So in addition to the cash that they send us, there were some sales that were happening in the final week of 2017. Because here's how it works. Let's assume we're dealing with December, the month of December. So this is the month of December. The business, let's assume the businesses, they make sales in December. They make the sales in December. So they make the sales here. But they don't submit their taxes until maybe 10 to 15 days the following month. So they don't submit their taxes until maybe January 10th or January 15th. So it doesn't matter. So here what's happening is they collected 60,000 in taxes. The merchant collected 60,000 in taxes in December, which is year one, but it will not be submitted to the government until 10 days into the following month. This is January. So what's going to happen is, so in addition to the 1,350,000, we have a receivable from the government, because the government, the federal government will send us this, or the state government, due from state government, 60,000. And what is this? This is also revenue, because we're going to be receiving it 60 days in 2018, because this is year 2017. We're going to receive it within 60 days of 2018. Therefore, we debit due from state, which is a receivable. We have a receivable, and we count it as revenue. Okay. So let's look at the journal entry. So the cash that we received is 1,350,000. Now I'm going to combine those two entries. Due from the state government is 60,000, and this is for the money that the merchant collected in December, which is going to be submitted to the state government in January, which the state government will send us within 60 days of the beginning of the year. And our revenue is $1,410,000. And what type of a revenue is this? This is sales tax revenue. So this is another source of revenue. Also, the government could have various sources of revenues. Let's assume they collected $1,450,000 from various sources of revenue, such as license permit, $540,000, fees, fines, and forfeits, like fines, parking fees, so on and so forth. Intergovernmental revenues, $350,000, charges for services, $100,000, and some miscellaneous revenue, $30,000. So those are different type of revenues. They're going to debit cash, $1,450,000, and credit revenue control, which is for this various revenues, $1,450,000. And these revenues, we cannot accrue anything because we cannot accrue them. We only count these as revenues when we receive the cash. Therefore, this is how much we received. Okay. Now we're going to go ahead and repay that note that we borrowed. Remember, we borrowed $200,000. We made some collection. It's time to pay the note. And let's assume we incurred $5,000 in interest. Therefore, we're going to pay $205,000, $200,000 for the note. So the note is gone, and we're going to debit expenditure control for $5,000, and this is basically interest. But we don't call it interest expense. It's expenditure control. Remember, we are dealing with government. Okay. Now let's go ahead and recognition of expenditure for encumbrances. Remember, we encumbered. Encumbered means what? It means we said we're going to spend. We issued purchase order. Let me go back and show you this. $826,000. We encumbered $826,000. At some point, we're going to start to make the actual purchases. So let's see what happened now. Okay, some of the material and supplies ordered last year and this year were received. Remember, we had from last year $45,000 reserved for encumbrances. Remember, at the beginning of the session, I said of the $290,000, $45,000 is reserved for encumbrances. So we received some of these encumbrances. Invoices for the item received were $820,300. Related purchase order were $821,000. So we submitted purchase order of $821,000. The actual was $820,300. So they cost us a little bit less, $700,000. After inspection of the goods and supplies, the invoices were approved for payment. So we received the material, excellent. They were in good shape. We approved them for payment. Okay. Since the purchase order have been recorded as encumbrances against the appropriation, it's necessary first to reverse the encumbered amount and to record the expenditure and the amount of the actual liability. Remember, you have to do two things. First, we have to reverse the encumbrance. We reverse the encumbrance for the original estimate. The original estimate was $821,000. Therefore, we reverse the encumbrance. This entry here is to reverse the encumbrance for the actual $821,000. Okay? But it didn't cost us $821,000. It only cost us $820,300. Okay? So what's going to happen is this. We're going to debit expenditure $45,000 for the prior year. The prior year we had that expenditure outstanding. Now we're done with it. We debit expenditure control $775,300, and we're going to credit accounts payable for $820,300. Let's add this up. I think I made a math error here. Just give me 1 second. 45,000 plus 775,300, 820,300. So the accounts payable is 820,300. Again, this amount here. This is the actual expenditure. So the actual expenditure. So we're not going to pay 820. We're going to pay 820,300. That's just, it's an error from my end. Okay. So that's that. Now we're going to go ahead and start to pay our employees. This is transaction 14. The gross pay of employees of the General Fund Department amounted to $3,345,000. Okay, no encumbrance is used for payroll, so we don't encumber this amount. So deduction from the gross pay for the period amounted $78,000 for employee state income tax withholding, $686 due to the federal government, $440 for the federal government tax withholding, and $256 for the employee share of Social Security and Medicare. Oh, that's fine. Let's go ahead and do this entry. We're going to debit expenditure control, which is basically the salary expense, $3,345,000, due to federal government, $686, due to the state government, $78, and the employees should receive in wages and net pay of $2,581,000. When we cut the checks to the employee, we debit payable and we credit cash. Basically, hopefully we all know how to do this entry. Basically, this is like in actual accounting, GAAP, except that we don't do an expense. It's called an expenditure. The debit is to an expenditure. Also, remember, the government will also have payroll taxes to pay. Okay, so the village is liable for the employer share of Social Security of $256. They have to match the Social Security, and for the contribution to additional retirement funds established by the state, assume the amount is $167. So they have to pay their Social Security, and they have to pay to the state $167 to fund the retirement of the government employee. Therefore, they have another expenditure control of $423, which is another expense, $256 for the Social Security, and $167 for the retirement, for the pension. So this is basically, again, regular expenditure. Okay. Payment on account and other items. So also the government now, they're going to go ahead and pay their liabilities. Payment is made on $770,000 of the accounts payable. So if you kept track of your accounts payable, if you are keeping track of your accounts payable, I'm not sure what's in there, but you have more than 770. So you're going to pay 770 for the payable and the amount due to the state government and the federal government. What's the amount due to the state and federal government? This is the amount due to the federal government. The federal is 256, the state is 167. So now you're going to make the payment. So you're going to pay the government, you're going to debit those liabilities, debit accounts payable, and credit cash. Basically paying liabilities. Again, this should be straightforward if you're in a governmental accounting course. This is basically paying your liabilities. Okay. Correction of errors. This is transaction 17. Here's what happened. Let's assume duplicate tax bill totaling $1,200 were sent out for the same piece of property. So what happened? For the same piece of property, we send one bill for $1,200, we recorded the receivable. Then we send another bill for the same property for $1,200, we recorded the receivable. So what do we have to do? We have to reverse what we did. We debit revenue control, we credit receivable. We just basically reverse what we did, because when we send the bill, we debited receivable and we credited revenue control. Now we do the opposite. Okay. Again, this is property tax revenue. Now, since we discovered this error in this year, basically we can fix it. What happened if we discover it from a prior year? Then the revenue is not there. So what we do is we fix it to the fund balance. We fix it to the fund balance. Okay. Amendment of the budget. This could happen too. Remember, the first entry was to record the budget, but throughout the year, the city or the village or the borough may meet again and increase the budget, increase their expenditure, or increase their revenue. So that could happen. Okay. So now what happened here? Assume that the revenue budget was increased by $50,000 in the charges for services. So basically they expect to receive more, $50,000. And that the appropriation for the Public Works Department was increased by $100,000. So good news, we increased it by $50,000, but our appropriation increased by $100,000. So our expenditure increased by $100,000. Now we need to amend the budget. Basically, we need to debit estimated revenue $50,000, appropriation credit $100,000, and the difference is a budgetary fund balance of $50,000. Basically, this is like your equity went down by $50,000 because your expenses are going to go up more than your estimated revenue. That's fine. Okay. So now again, if you are keeping track of your estimated revenue control, I'm not sure what it was initially, but now you add 50,000 to it and you add to the appropriation control 100,000. Let's take a look at it. What was so let me just show you what happened here. This was the first entry. Appropriation was 5.2 million. Now it's going to be 5.3 million. And estimated revenue was 6.2. It's going to be 6.6 and a quarter. Okay, so why? Because we increased estimated revenue and we increased the appropriation. So just want to let you know what we did here. So you see the continuation of it. And hopefully you are keeping track of your T account. Therefore, you see exactly what's happening. Okay, now we're going to move the interfund transaction, and we're going to do a few of them, starting with transaction 19. Interfund services provided and used are recognized as revenues and expenditure. Remember, we have reciprocal and non-reciprocal interfund transfer. Make sure you view the interfund transfer. So if it's reciprocal, we're going to record it as an expenditure and revenues. Okay. In the same matter as transaction with outside organizations. So if the exchange is considered reciprocal, it's going to be an expenditure for us and revenue for the other party. Okay. So the water utility ordinarily provide the city with the fire hydrant and water services for fire protection at a flat annual charge. So we have another fund. It's called the Water Utility Fund, and that fund is an enterprise fund. Basically, it's an independent fund. And what we do, the city needs water, obviously, for the fire hydrant, for their buildings, so on and so forth. So the other government, the enterprise fund, charges a flat fee. Assuming the flat fee is $80,000, Okay, so the enterprise fund is charging the general fund 80,000. How does the general fund record this transaction? It's basically an expenditure. It's like an expense. We're dealing with another unit outside the government, although it's within the government, but this is considered a reciprocal transfer. Therefore, we debit expenditure 80,000. We credit due to water utility fund. Basically, we owe them 80,000. And eventually, you're gonna learn about this utility fund, this water utility fund, which is an enterprise fund later. They would record it as revenue too. Okay. Let's look at another interfund transaction. Another common transaction for the general fund is the receipt of supplies or services from the internal service fund, established to centralize purchasing and distribution services among governmental departments. Also, the internal service fund is considered its own. It's part of the enterprise fund. It's independent, considered quasi-independent. Therefore, when we deal with them, as long as we're getting something in return, we're going to treat this as a reciprocal transaction. So assume that the general fund received 377,000 in supplies from the supplies fund and later made a partial payment of 322. So basically, in a sense, we bought supplies from them. So we have an expenditure, 277,000, and due to the supplies fund, 277,000. This is an enterprise fund, a separate fund. Basically, it is a governmental fund, part of the government, but it's considered quasi-independent. Then we pay them 322. Therefore, we debit the supplies fund due to supplies fund, which is a liability, and we credit cash. Pretty straightforward. More interfund transaction, assuming the general fund made the budgeted transfer to the debt service fund for a future payment of interest and principal. Now what's going to happen? The general fund is transferring money to another fund, to the debt service fund. So the general fund is transferring money to the DSF, debt service fund. Now, when we transfer money, are we getting anything in return from the debt service fund? Absolutely not. The only thing we're doing is we're transferring some money to the debt service fund so they will make the payment on the loan. Therefore, we have no expenditure here. How are we going to do this? We're going to debit other financing uses, transfer out control, which is an income statement, in quote, an income statement account, but again, not an expenditure. It's a transfer. Notice it's a transfer, not an expenditure, and due to the service fund, basically due to the service fund. Again, this is not an expenditure. This is important because it's a non-reciprocal transfer. We're transferring those funds, and we don't expect the debt service fund to give us anything in return. They're not going to give us anything in return. So this is other finances uses. It's basically statement of revenue expenditure account, but not an expenditure account. Now, when we transfer the money, we debit the liability and we credit cash when we transfer the money. Once again, no expenditure here, no expenditure. More interfund transfer, assume that the general fund made a permanent transfer of 596,000 to establish the internal service fund. Now let's talk about this. Remember, the internal service fund charges for the supplies. Notice here, the internal service fund, when we get the supplies from them, they charge us for the supplies. Therefore, we had to debit expenditure. Now, we're going to establish another internal service fund. Okay? Now, we're going to establish another internal service fund. So my question to you is this. Would you consider this a reciprocal or a non-reciprocal? And this transaction is non-reciprocal. Although this internal greedy transfer internal service fund will charge us for the services, but when we initially establish the fund, we don't expect anything in return. Therefore, it will be other financing uses, transfer out 596 and cash 596. So in total, we transferred out 800,000 in non-reciprocal. 204 went to the debt service fund and 596 went to establish this internal service fund. Okay, this is non-reciprocal. To establish the internal service fund, non-reciprocal, but when they provide us services, they're going to charge us. They're going to consider it reciprocal. More interfund transfer, assume 20,000 of the expenditure in the entry related to supplies used for road maintenance that should have been charged to the motor fuel tax fund. Okay, so here's what happened. You remember we received some supplies. We ordered supplies and we received the supplies. But part of these supplies, 20,000, we shouldn't have charged it to our fund. It was part of the motor fuel tax fund, which is a special revenue fund. So simply put, we paid for $20,000 worth of material. That's not really our responsibility. It's the responsibility. And what we did is we basically, in a sense, we debited an expenditure, not in a sense, we debited an expenditure for 20,000 and we end up crediting cash for 20,000. all said and done. This is what would happen. So we paid $20,000 worth of material. That's not really ours. It was for the, it's for the motor fuel tax fund, because it's for road maintenance. It has nothing to do with the general fund. It was for that fund. So basically, what's going to happen? This fund will have to pay us back $20,000, and we have to reduce our expenditure $20,000. Okay, to correct this $20,000 cash is moved from the motor fuel tax fund to reimburse the general fund. Basically, they have to pay us back $20,000 because we paid that $20,000. They should have paid it, so they have to pay us back. So $20,000 is charged to the motor fuel fund, and the general fund expenditure are reduced by $20,000. So we're going to get the cash back, debit the cash, and credit the expenditure, because that wasn't our expenditure in the first place. Okay. So this is, again, in a sense, it was a mistake. So we took care of that. We asked them for $20,000 and they paid us. Write-off of uncollectible delinquent taxes. So this is transaction 24 and 25. So you might be saying, hold on a second, does the government write off uncollectible delinquent? I mean, think about it. The government always, they can take over your property to collect their taxes, but sometimes your property is not worth the amount of money that you owe them. So in other words, you might owe $50,000 in taxes, okay? But your property is worth $30,000. This is how much is your property worth, the fair market value. So although the government took over your property, they sold it for $30,000, you owe them $50,000, now they have to write off $20,000. Because some of you might be saying, the government should not be writing off anything because they could always get their money. Yes, they can always get their money, but you cannot, as they say, take blood from a rock. If there's no money from the taxpayer, there's nothing that they can do. Okay? So the government official should review each schedule of receivable periodically to determine the adequacy of the allowance account and the authorized write-off of items judged to be uncollectible. And from a control perspective, the government here, they have to trust the person. They should have internal control of who's writing off these accounts, because what could happen is this. If someone can write off these accounts and receive the money from in other words, if someone can say, well, we're going to write off this account, and no one is reviewing this process, and that individual can collect the money from the taxpayer. So what they do, they would write off the account, collect the money, and pocket the money. So this is a very sensitive process for the government. So you should have multiple reviews level before the government write off an account. So for example, not one individual should be able to decide, well, this account is uncollectible. It might have to go through 2 or 3 layers to make sure that the process is being done. Okay, because somebody could be writing off the account and pocketing the money. Okay, when delinquent taxes are deemed to be uncollectible, the related interest and penalties must also be written off. Of course, if you cannot collect the main balance, you're not going to collect the interest and the penalties that's related to that account. So when you remove the account, you remove any related interest and penalties. Hopefully this makes sense, okay? Because if they cannot pay off their balance, they're not going to pay you the interest and the penalties. So the treasurer of this village, it's called Riverside, received approval to write off delinquent taxes of $30,000 and related interest and penalties of $3,000. So they're going to be removing $30,000 of taxes receivable and $30,000 of interest and penalty receivable that are related to this. So what we do is we debit estimated uncollectible taxes and credit taxes receivable. Basically, those receivable are gone. Debit estimated uncollectible interest and penalties $3,000, and credit interest and payable and penalty receivable. It seems the penalty is 10% of the amount. Notice $3,000 versus $30,000. It doesn't matter, but we have to write them off. Okay. Now also, the government, they still have uncollectible that they're going to be collecting. They have the right to accrue interest and penalties on them. Okay. So if there is delinquent taxes, we can accrue penalties and taxes on them. So delinquent taxes are subject to interest and penalties. The amount of interest and penalties earned by the general fund and not yet recognized is $56,410. It's expected that only $39,410 can be collected. So they expect $56,410 of interest and penalties, of which only $39,490 to be collectible. So they have to estimate an uncollectible account. So the debit to the receivable for the full amount. However, we estimate that $16,920 will not be collected. Therefore, we could recognize revenue of interest and penalties of $35,490. Again, what type of revenue is this? Interest and penalties. Interest and penalties. Now we're getting till the end of the year, deferral of property tax revenue. Again, remember, at the end of the year, what's going to happen is this. The government will have to decide, this is year 1, and this is year 2. All the taxes that they impose for year 1, okay, as long as it's collectible within 60 days, it's revenue. So all of this plus this, those 3 axes are revenues. Anything that's going to be collected, whoops, let me go back. Anything that's going to be collected after this time, which is in this area here, 60 days after year 2, it's going to be what? It's going to be deferred to the following year. So a review of the taxes receivable subsidiary ledger indicate that the approximately 40,000 would probably be received more than 60 days beyond the year end. Remember, when we started this year, that amount was 20,000 from the prior year. Now we need to estimate this year. Therefore, we have to debit revenue control to remove 40,000 out of our revenue because we don't think we're going to be receiving this amount. And the third inflow of property tax is 40,000. Now we establish this deferred inflow of property tax of 20,000. So simply put, on your trial balance now, you should have a deferred inflow property taxes of 40,000, which can be received in recognized as revenue in 2018, which we reverse this entry in 2018 once 2018 started. Okay, but for now we have to take it out of 2017. So we reduce our revenue by 40,000, deferred it to 2018 because we cannot collect it within the first 60 days. Last transaction, I believe this is the last transaction. This is a special item. GASB standard required that extraordinary items and special item to be reported separately after other financing sources and uses. So if you sold something, like if here we're going to sell a piece of land, this is a special item, it will be reported separately. Extraordinary items, which is this term is no longer used for financial accounting, are significant transaction or other event that are both unusual and infrequent. For example, selling a piece of land is unusual and infrequent for a government. So special item are significant transaction or other events that are either unusual or are frequent but within the control of management. So here what they did is they sold a land of 300,000. Debit cash, credit special items proceeds from the land, 300,000. Okay, so if you are following, and this is if you are following those journal entries and updating your T account, this is what you should have. Those T accounts that we started with, and this is your trial balance. This should be your trial balance. And notice here, these are highlighted differently in gray because those are the budgetary account. Those are the budget. And what do we do with the budget? We're going to close all of those. All of these will be closed. Wait until we get to the closing. Also, I just want to make sure you understand that those are the balance sheet account. Okay, those are the balance sheet account. Again, the general fund balance sheet account, okay? And I'm going to highlight those in a different color. And those orange here are revenues, expenditure, and the change in fund balance account, okay? Okay? And again, these gets closed as well. These, we close these, the budget account, as well as the statement of revenues, expenditure, and fund balance account, okay? This is the trial balance, basically an official trial balance. Notice assets are listed first, then liabilities next, then liabilities, then fund balance, then revenues, then expenditure. Basically, looks like a typical trial balance, and these are the budgetary account. Okay, we're going to close those, and we're going to close all of those. Okay, budget and revenue and expenditure will be closed. Okay. Here we go. Here's the closing of the budgetary account. We have an appropriation, 5.3 million. Remember, the original appropriation was 5.2 million in entry 1. Then we added 50,000 down the road. Therefore, I'm sorry, 100,000, not 50,000. We added 100,000 in appropriation. We closed this estimated other financing uses control. Remember, 204 went to the debt service fund, and the remainder to establish an internal service fund. Estimated revenue control. The revenue initially was 6.2 million. Then we said we're going to get another 50,000. So the budgetary balance was 6.25 million. And what's going to happen is we're going to have 50,000 of remaining encumbrance. In other words, we did not receive 50,000 worth of material that we purchased. So this is going to be budgetary fund balance reserved for encumbrances and encumbrance control. We're going to remove this 50,000 from this year. We'll establish it next year. Also, we need to close the statement of revenues expenditure to fund balance. So basically, we need to close our actual revenue account, the special item account, close our expenditure, close our other finance and uses transfer out control, and credit the fund balance. So the fund balance, what end up happening is our revenues and other income were higher than our expenditure and other finances for $550,990, which is good. So this is the closing. This is the closing entries. This is the budget. And this is the statement of revenues expenditure account. Okay, here's the actual balance sheet. This is what you should have on the balance sheet. Cash receivable should be taxes receivable delinquent and less the estimated uncollectible. Interest and penalties receivable, this will be less the estimated, and due from the federal government of $60,000. You remember this is for the sales tax. So this is your total asset. Your liabilities, your accounts payable should have $50,300. You owe the water utility, and you have due to supplies fund $55,000. This is your total utilities. We have deferred inflow of resources. Remember this $40,000. We're going to be turned into revenue in 2018. It's a liability for now. It's not technically a liability, but it's a deferred inflow of resources. Let's not call it a liability. We have fund balances, and here's the fund balances. They broke it down for us: 75 for public, restricted for public works, 100 committed for capital project. Don't worry, this is just given. Okay, so the total fund balance is $840,990. This is the balance sheet. This is the statement of revenues, expenditure, and changes in fund balance. First, we'll start with our revenues. Obviously, the largest one is the property taxes, and hopefully you get to this number. Then you have interest and penalties, you have sales tax, and you have all sorts. Remember, this is, I don't remember what entry, but those were all put in one entry, 1 million, if I remember, 450,000, if I remember the number is correct. So those are the various entries. This is our total revenues. And here are the expenditure. Don't worry, they broke them down, you know, general government, public works, public safety, health and welfare, all those, it doesn't matter. This is the expenditure. The excess of revenue over expenditure, we call this excess because we have more revenues over expenditure, 1,050,000. We transferred out 800,000. Then we sold that piece of land for 300,000. So this is minus, this is a plus. So the net change in the fund balance, 550,990. Again, we can confirm this. Oh, sorry, we can 550,590. Plus the beginning balance should give us an ending balance of 840,990, which is right here, 840,990. Okay, so this is basically, in a sense, as I always say, this is an income statement and retained earning at the same time. So this is an income statement and retained earning, 840,990. Then this number will appear on the balance sheet, which is 800,990. Okay, basically, again, because it's a retained earning account. And here's a breakdown of what they want us to do with the fund balance, 849.90. Again, this is given, don't worry. 75,000, they have no non-spendable category. Restricted, they have 75,000 from the fund balance. Restricted, unexpected portion of the state grant they use to support public works, that's fine. Committed, they have 100,000, they want to buy communication equipment. And they have $50,000, again, purchase order outstanding at the year end, which is, we encumbered them, but we haven't received the order. And 615,990, we can do whatever we want with it. Okay, this is basically, hopefully, a comprehensive example from A to Z. We started with a trial balance, an existing trial balance. We went through the examples till the end. Hopefully, this is this helped you understand how the general fund accounting work. If you have any questions, any comments, by all means, email me or see me in class. Otherwise, study hard, complete your work. And if you're studying for your CPA exam, always, 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 as I say, study hard. It's worth it.